On behalf of the American Association for Employment and Education, I'd like to welcome you to the AAEE sponsored webinar, Student Loan Solutions, Helping You Prepare Students. My name is Tim Newbert, and I have the privilege of serving as the new Executive Director of AAEE following the end-of-year retirement of Deb Snyder. Before we begin with our webinar, I'd like to thank some of my colleagues. AAEE Board Member Daphne Donaldson from East Baton Rouge Parish Schools, who directs our Professional Development Program, and Sarah Russell, our Strategic Marketing Manager, for her leadership role in preparing and hosting today's webinar. For those attending live, please note that if you have technical difficulties, you may send a message to any meeting by clicking the button in the upper right-hand corner. Also, during the webinar, all attendees will be muted. However, at any point, you may submit questions via the chat feature. Jim and John will allow time for questions towards the end of their presentation, so throughout the webinar, please submit your questions and comments via the chat box, and they'll try their best to respond to all questions during the event. If you are not currently a member of AAEE, you can find more information on our website at AAEE.org. I should restate that as AAEE.org. We are an organization that brings together the college and university professionals who prepare future educators with the employers who hire them. Related to that mission, we offer publications and events such as the Job Search Handbook for Educators, an annual teacher supply and demand report, a calendar of education-specific job fairs held around the country, an annual conference and career fair, which was held in Pittsburgh, Pennsylvania last fall and will be held in St. Louis, Missouri in November, and of course, our webinars. Today, we're pleased to have our friends Jim Yale and John Bernardy from Horace Mann. Jim serves as Vice President for Association Relations, leading the company's efforts to assist employers with worksite programs designed to improve employee financial wellness, while John serves as Director of Student Loan Solutions, focusing on the company's efforts to help educational employees manage student loan debt. Today, Jim and John will share new ideas on how University Career Services offices can prepare their students to manage student loan debt, and as well as understand how educating students on available federal programs and strategies can encourage students to pursue a career in education and stay longer once they start. Thank you for sharing your insights and information with us today, Jim and John. I'll now turn it over to you.
Terrific, thank you. We'll go ahead and get the PowerPoint fired up here. This is Jim Yale, and I'll do a lead in and then turn things over to John with regard to the discussion specifically on student loan debt management strategies. For starters, I'd like to share a little bit with you for those of you who don't know Horace Mann. Horace Mann was founded back in 1945 by two educators in Springfield, Illinois, which is where we still are located with our corporate home office. I will comment that if you do hear a train in the background, the reason why is that our home office happens to be between two sets of tracks that come through our city here. The company started as an auto insurance provider to members of a teacher credit union here in Illinois, and we expanded and now have roughly a little over 700 agency owners in nearly every state in the country. There are just 3 states that we don't do business. We are a personal lines insurer, and we have been involved with retirement savings programs since 403B programs became available back in 1961. Our commitment is solely, and as you can see by our name, our commitment is really solely focused on the needs of educators around the country, and that would include folks such as yourselves who are involved with higher education. And so the topic that we're going to talk about today actually is of interest both from your standpoint in placing new teachers, and we had a similar webinar that was done earlier this week that was tailored toward the school districts and those folks who are involved with hiring new educators and handling new employee orientation. And so this webinar is an example of our efforts to help employees understand basic financial wellness, as well as issues that specifically impact them, one of which is student loan debt, and another is their retirement options and saving for the future. We do have a number of partnerships, including the partnership that we have as a sponsor of the AAEE Annual Conference. We serve as a member, and we're also an advertiser in the Job Search Handbook, which, by the way, is an ad related to the topic that we're going to discuss today. We also work with AACTE and are a sponsor of their national conference and provide a workshop at that conference annually, as well as webinars for that organization. In addition to those partnerships, we are also a strategic partner with AASA, the Superintendent's Association, ASBO International, which is the School Business Officials, and we are also a sponsor of DonorsChoose.org. So our efforts basically are focused on educating educators and also supporting their needs, and we make attempts to educate as well as financially support their needs in the classroom, and work with their employers with regard to employee education on a range of topics related to financial literacy, student loan debt management, as well as how to fund for needs in the classroom. So I'd like to turn to the topic at hand today, and we were kind of joking in the prior webinar that my portion of the presentation may be termed the gloom and doom portion, but I'd like to set the stage, and I'm sure that many of you are probably well aware of a number of the topics that I'll touch base on here to open up the webinar. But let's talk student loan debt and how it relates to the average teacher salary that we see as folks are coming into the profession. So the average teacher starting salary, according to the National Education Association, is a little bit over $36,000 per year. And on average, the average college graduate has student loan debt that is actually north of $37,000, and I'm sure, as John's going to share, we actually see with the educators that we assist that on average we tend to see college student loan debt for them in the range of $50,000. And so if you can imagine it, we have folks going into the profession who have debt loads that are larger than they're making in an entire year. And so the impact there in terms of their financial stress is pretty strong. And we do have teachers that tell us, we have an educator advisory panel of several hundred educators around the country that we do polling and we do other focus group activities with. And a couple of things that they have told us that are notable quotes are, we make less, so you just have to budget what you can afford, and I have very little extra money for savings. Another quote that we hear is that early in their career, teachers are paid significantly less, and it makes it a struggle to pay off student loan debt. And so in our research, what we found is that if you take a look at the monthly take-home pay of a new educator related to their student loan debt payment, they're actually paying out on average about 13% of their monthly income just to service and pay down their student loan debt. So the picture
Hey,
for them
Jim,
is, yes.
do you mind just sharing your PowerPoint with us? We can't see it right
Oh,
now.
I'm sorry. We thought we were.
That's all right.
Thanks for breaking in. We didn't see that.
Yeah, it looks like you're up now. Thank you.
Okay, great.
Awesome.
So, basically, this puts that new employee coming into this profession and the employer in the position of what have I gotten myself into because I've got high student loan debt payments and they kind of get hit with the something that they may have already known going into the profession. Is that I'm not getting paid quite as much as we'll show as other folks that are in similar occupations that require similar education. I'll pause just a second while the train goes by. I knew we would have one, guys.
It never fails. Never fails.
There we go. Okay, so in addition to the student loan debt pressure, there are other pressures that we see that tend to be kind of unique to educators. And what our advisory panel tells us is that roughly 85% of them, 85% of teachers, spend their own money on classroom supplies. 92% of those teachers buy instructional materials for their students. And on average, and we actually believe this is probably understated, but they tell us that each teacher on average spends roughly $500 per year for the needs in their classrooms that are not covered through the school district's resources. So kind of pulling it all together, as you look at the educational profession, other occupations, as I mentioned, with similar educational requirements tend to get paid roughly 12% higher salaries than what teachers receive. And unfortunately, there is evidence to suggest that this gap widens over time. And so as you look at that, and then you also look at changes to state retirement system benefits, there is kind of a wave that is going across the country where the old bargain of, hey, I know that if I go into the teaching profession, I know that I'm probably not going to get rich salary-wise from it. I know I'm going to get paid less. However, I know that I'm going to have a pension at the end of my career. And for years, that's been the bargain that educators were provided going into the profession. And that promise is increasingly no longer there as states move to hybrid retirement programs and to defined contribution as opposed to defined benefit retirement systems. And so our educator advisory panels, one of the things that they tell us, and this quote shows it, is one of my biggest worries is retirement. Because my salary is less to begin with, my retirement pay will be significantly lower. So now to kind of continue with some of the gloom and doom, and I am going to assume that for the group that is on the phone or will be listening to this webinar recording, we are seeing an increasingly severe shortage of teachers in the country. The causes for that are an increased demand for teachers and I'll use an example. We're here in the state of Illinois, and schools in the state of Illinois are hopeful that they will have rebounded from the Great Recession, and we also have changes to the school funding formula where the intent is that there will be additional resources available, which means that they're going to have additional positions available, but there aren't new teachers to fill them. There's also a decreased supply of teachers, and I'm sure this is, if you look on the lower left-hand corner, there's been a drop in the participation in traditional teacher prep programs. Teacher attrition also remains high, and it tends to be the single biggest contributor to the shortage. And evidence of that is that as you look at teachers during the course of their career, and as we do educational work and work with teachers and other educational employees on retirement, we find that roughly 2/3 of educational employees actually leave the profession before they reach full retirement age because they're dissatisfied, either because of the whole range of other subjects that we won't talk about in this webinar related to the challenges of being an educator today, or the financial pressures that we've shared earlier. So, however, as I turn things over to John, it really does not have to be doom and gloom. And John may share a bit about this as he goes through his portion of the presentation here. But as AAEE is a very unique organization, since you bring together people such as yourselves who are placing new teachers with hiring school districts. And what we've learned over the course of work with AAEE, with AACTE, and with school districts that we serve, is that there is a disconnect between those seniors that are coming out of teacher prep programs and the hiring school districts with regard to helping them with the financial challenges that we've just provided an overview about. Here's the good news. Lee Sucher, who is one of the authors of a study from the Learning Policy Institute related to the teacher shortage, pointed out that in times of shortage, policymakers often focus attention on how to get more teachers into the profession. And so we see that, by the way, with alternative prep programs and other means to get people into the profession. But she points out that, and I think Lee is a female. I'm not positive. I'll apologize if she's not. But it's equally important to focus on how to keep the teachers we do have. And the point here is really important. And I think that it can apply to you folks who are on the webinar, that if efforts can be focused to reducing attrition in half from the 8% per year turnover that's normally seen to 4%, it would virtually eliminate overall shortages. So we're hopeful that the information that John is going to share with you next would be useful to you in your positions and could help you differentiate your college or university and your teacher prep program by preparing students to manage and take advantage of really some truly life-changing programs that are available to them that will make it much easier, will make it much more attractive for them to stay in the teaching profession. So with that, I'll turn things over to John.
Well, thank you, Jim, and good afternoon, everybody, or good morning. I appreciate the opportunity to do this today. Jim, with his introduction to the company, I think did a really good job highlighting what we do, but I want to make sure that one way I like to kind of introduce it is to say that we've got our business side and our partnership side, our value partnership side, and then Jim really heads up that value partnership side. And what we do is focus on those issues facing educators, like Jim said, and try and find ways to save them money. So I feel like a lot of what we do is missionary type work, because our goal is going around helping educators save money across the country. And this increases their career longevity and also gives us potentially a chance to sell them our tailor-made educator products. But at the same time, at no cost to them, we just go around helping people, and it's just a great thing to wake up to every day. Under Jim, I'm privileged to lead our Student Loan Solutions group, and really we've got a team here in Springfield, Illinois that's dedicated to helping teachers with the student loan issue. And about that issue, looking at the slide in front of us, we've got $1.499 trillion in student loan debt. That number is federal and private loans combined. About 8% of it is private loan, but most of it is a federal loan debt. And these loans are such a massive problem. The increasing costs of education, you're probably more aware than I, are just almost unsustainable with this current debt. And then as far as the valuing limits that folks are allowed, there's just a whole bunch of problems here. But I want to try and put that number in perspective. And the best way to do that is to say that, it's more than credit card debt. If you think about credit card debt as a nation, it's bad. The average person has a pretty decent amount. Student loan debt's worse. If you take auto debt and compare it to student loan debt, same story. Auto debt, several people owe money on a car. It's very common to owe on a car. The amount of student loan debt is higher than the amount of auto debt. So take your auto payment, increase it by a little bit, and call it a student loan. And you can't drive it. It's not going to keep you warm at night, but that's something that these teachers right out of college are being forced to pay. Like Jim said, the average is $37,700 for the undergraduates. For teachers, like he said, we see a much higher number for the average educator. It's between $45,000 and $50,000. So not only are they often making less out the door than their peers with an undergraduate degree, but they're saddled with more debt. And in this case, and what we'll get to in a moment, that can actually be somewhat of a good thing. But the primary reason, one reason Horace Mann is really engaging in this is because we see, and this is from our same career teacher panel, that a lot of educators are thinking about leaving the career path simply to find a career change that can pay them better. And that's really unfortunate. So we want to soften that and to help reduce that attrition. And we believe that there are programs out there that are actually designed to do just that. They're just not advertised as well as they could be. So that's really our goal here today. Most of the programs that I'm going to talk about are not Horace Mann programs. They are federal programs, but they can be rather complex. And Horace Mann has mastered the ability to navigate those if you're a teacher, if you're in education. Little plug for our group, our team, Student Loan Solutions. What we are charged with doing for educators is helping them remove their debt. When it can be forgiven by student loan forgiveness, we want to make sure that they're getting that loan forgiven. They've earned it. They've earned this loan forgiveness, and it's already available to them. How can we help them access it? We help them reduce their payments. Often this is by alternating their current payment plan from something that they're currently on to something that's available to them that they simply don't know about. And in many cases, their servicer or the person responsible for their loan won't share with them. So we help them do that, and in some cases refinance it. And then importantly, we help them start redirecting that money because this redirect is so important because it helps teachers, they have that lower than average income. And like Jim was saying, they're able to retire on time. They're able to have that fulfilling retirement. And if they start early, that time value of money is on their side. So this really is one way to free up those dollars right out of college so that they can start saving, even if it's just a little bit, towards having that retirement. So I want to talk a little bit about some of the programs that are out there. The first and most popular is teacher loan forgiveness. Now, teacher loan forgiveness has been around since the 90s, and what it is designed to forgive $5,000 for educators who serve for 5 consecutive years in low-income qualified or Title I schools. This is about 40% of the schools in the public school systems in the country. So private school teachers do not qualify. But those classroom teachers, after working for 5 consecutive years, all they need to do is send in a form, and they're going to have $5,000 forgiven off of their federal loans. Now, if that teacher teaches high school math or science, in some states junior high math or science, and then any grade of special ed, that number for teacher loan forgiveness jumps up to $17,500. So this is something that you can share with your outgoing students, your outgoing educators, so that they know, hey, after you teach for 5 years, you've got this option. But more importantly, and I want to share with you something else. So this is a way that we feel we can help reduce the attrition in the industry, is through helping teachers access public service loan forgiveness. Now, public service loan forgiveness is exactly that. It's a federal government program designed to incentivize longevity in career choices that are public service roles. in this case, teachers, are a perfect qualified applicant for this program. Now, I'll share with you that there are 33 million Americans that qualify for this program, and just over 600,000 have applied. So there's a very big awareness gap in this program, and we feel like our mission of sharing this program with educators might be able to really solve the teacher attrition problem, or at least put a huge dent into it. So what is public service loan forgiveness? The premise is this: it's pretty simple if you break it down. If you make 120 qualifying monthly payments or 10 years of payments on a qualified federal debt loan, and you work for a teacher organization or a public service role in a public service role full-time, everything you owe is forgiven after that 120th payment. So you make 10 years of payments, you've got a federal direct loan, which most do, and you work for a school district, everything you owe is forgiven after you make 10 years of payments. So our job as Horace Mann local representatives, we like to coach teachers on how to make the minimum possible qualifying payment so that they can get that 120th payment made as soon as possible and for as little dollars out of their pocket as possible. And in some cases, this dollar amount can actually be $0 a month that can count. So when we give these workshops at large association meetings or in person, and in fact in Pittsburgh this last year, I had a slide that said, what is your current repayment plan? You know, what is the payment plan that you're currently on? When we ask teachers, more often than not, they don't know. You know, they know that a certain dollar amount leaves their bank account every month, and that they hate it, and they know that it's going to be around for 30 years. They might have named it by now, and they despise and loathe these things. But we feel it's important to share some basic information on the types of loans that are out there, the repayment plans that are out there, so that they understand how they can make that qualifying payment plan for public service loan forgiveness. Now, right out of college, 6 months after graduating, and you, again, probably know this better than I do, your now teachers are going to receive a standard loan repayment plan in the mail. They're going to receive a plan that pays back their loan debt over 10 years, and it's the same dollar amount month to month, and it is expensive. So they're a first-time teacher, first-year teacher, and they're now paying $755 a month on their student loans. $755 is a lot. It's too much to afford buying that first house, maybe buying a new car. We hear often from our educator clients and people that we work with that they've put off having children or going on their first honeymoon or family vacations, all sorts of different things. You know, some struggle with their monthly bills. So they're paying this $755 a month, and then they call their loan servicer for help. And this is the most common case. They call for help, and then they get put on this plan that is maybe 20 or 30 years and will often cost them more money than this standard plan will. So it might lower their payment today, but it's going to be 30 years of payments where they're going to pay back significantly more than if they'd paid that $755 in the first place. What those loan servicers don't share is that everybody, and this includes every educator that you come into contact with that has a federal loan, all of those people qualify for income-driven repayment plans. And this is where educators can say, rejoice, that I don't get paid $1 million a year because my income-driven repayment plan is based on my income. And while there are a variety of different income-driven plans, our local reps help those teachers, the teachers in their area, select the lowest qualifying payment plan for that person. In this case, if you look at the numbers on the screen, we have a $36,000 annual adjusted gross income. The average interest rate on their loans is 6.8%, which is very common. That's what they're issuing today. It's a single teacher and $60,000 in loan debt. So again, that monthly 10-year payment plan would be $755, and they'll pay back $90,000. But what that teacher needs to know before they start making that expensive payment is they need to get on an income-driven repayment plan right away, right outside of school, so that they can be paying $149 a month, which is much more manageable. And then that way, over the course of the loan, the 10-year loan, they'll pay back $25,000, when again, they had originally borrowed $60,000, and they're going to see $75,000 approximately in public service loan forgiveness. And that's what this program is designed for. Like, they're paying for this program by remaining in public service and making that low salary for a 10-year span. And this is designed to compensate them and to thank them for getting that education. The problem, again, is that simply people don't know about it. So we help them make the lowest possible income-driven payment plan over a 10-year period so that they can also redirect that student loan money. Now that I'm saving $500, $200, $300, $400 a month for my student loans, I can afford to start putting $100 or $200 a month into my 403B account or my savings account or whatever vehicle that might be. In this example, we took $132 and annualized. You can see how, over a 40-year period, a 40-year career length, that number increases significantly over time to over $250,000, $250,000, and that's a small amount compared to what we see people save on an average basis. Our team, Jim and I were just looking at the numbers a few hours ago. In the last 3 months of the year last year, we helped 1,319 educators with their student loans, and the amount of monthly savings on average per month was about $42,000 per month. And we're really proud of that and just helping teachers with lowering their payments. So it's very important to do that so that they can afford to redirect towards those retirement vehicles. And here's the hero slide of our presentation. I want to kind of say this is how it all works. If you took Kate, this is a very common example. She's a brand new teacher. She's 24. She's got $30,000 in loan in adjusted gross income and $50,000 in loan debt, which, like I said, is what we see on average. She's coming to us and she's making this $347, almost $350 a month payment for the next 300 months, which I think is roughly, 100 years or 25 years. It's a long time. It is 25 years. And I'm looking at Jim. He's nodding. I think it is 25 years. The retirement savings, she's saving nothing per month. So she's just seeing this $350 for the rest of her life payment, and she's struggling. Now, if she were to be clued in with the programs that we've talked about that are designed to reduce the teacher attrition from the career, and if she were to, even more simply, hook up with her local Horace Mann representative, she'd be able to get on an income-driven payment plan and easily navigate getting from $347 a month to $99 a month. At this point, she's saving $250. She's probably in tears, and it's really a powerful thing. And then we say, how about we look at, potentially starting to save for your future? So Kate decides, I'm going to put $100 a month into my 403B account. One of my professors said I should do this, or my mom and dad said, it's important to save 10%. I'm not going to do that. I'm going to do $100 a month. We said, that's great. That's awesome. That's something. Well, when we do that, we readjust her income-driven payment, and because she's taken that investment income out, it lowers her income-driven payment from $99 a month to $89 a month. So she's saving additional money. Her student loan payment is now $89 a month. Now, Kate was 24, or is 24 when she gets this plan in place. It's very important she does that early, because for the next 10 years, she's going to keep teaching, and she's going to keep making that monthly payment. She's going to sign up for public service loan forgiveness. And then by the time she's 34, she's going to receive $88,000 plus in public service loan forgiveness, and she'll already have over $22,000 saved in her 403B retirement account at the age of 34. That is an amazing start for that age to have already rolling over to keep increasing towards retirement. I don't think there's a better way for us to really wrap up how this program works, except to say that it goes from, I've been looking at 25 years of hopeless, $350 a month, to now I'm paying $89 a month. I'm going to have a huge amount of savings, and my entire amount of loan, $88,000, is going to be forgiven, debt-free, tax-free. That's a very, very awesome thing. It's also a very common scenario when we connect with educators that are at this age, that are coming out of school. If you're able to, work with these people early and get them to understand these concepts, we've found that it's very, very easy to change their outlook on the career as a whole. Now, those on the phone, you probably qualify for public service loan forgiveness as well if you work for a 501c3 nonprofit organization or a government organization. You should know that the same process we looked at right there with public service loan forgiveness applies to loans for your children as well. So let's say I'm a 35-year-old teacher and I would like my child to go to school. I can take out a substantial loan for that child to go to medical school, and after I'm done taking out that loan, if I set up a public service loan forgiveness, I can teach for 10 more years. I can base that payment on my teacher salary and have my child's loan forgiven after that 10-year period. So this is a great reason, again, also to think about teachers. You know, they'll continue teaching if they know this. We've worked with teachers across the country that say, you know, I need to do this so that I can pay for my kids' colleges. And in fact, it's true. It's really a cool thing. Again, the awareness simply isn't there. So that's really that on Parent Plus loans. Now, the other thing is we see a lot of companies on Facebook and on the radio and on TV that are offering student loan help. A lot of these say that they're free or get a free case analysis or whatever you might call it. And they're often free until they ask for your credit card or debit card information because they want you to actually help them with something. We've worked with teachers now for the last 3 years, and we've seen dozens of cases where teachers have paid $1,000 up front and $49 a month for help to access these free government programs. And we would argue that this is something that they should never pay for. And also the Department of Education agrees with us. The Department of Ed has a blog dedicated to not paying for this loan assistance. And Horace Mann will not offer you any loan assistance for any sort of charge. I should probably add that we do have, like Jim said, 700 individual business owners. And after this webinar is completed, through the AAEE.org site, you'll be able to connect with your local rep or request a workshop in your school, or maybe set up a time to see how you can incorporate this literature, you know, to your benefit, because we feel like it's really important to get it in the hands of your outgoing students. Finally, refinancing. We talked about that a little bit. You hear ads for this as well. This is not a bad thing, but at Horace Mann, we only recommend refinancing when we've exhausted any and all federal forgiveness options. So the only people that we actually refer to refinance are those who have, you know, maybe they're not going to stay in education for another 10 years. Now, I should also add that 10-year program, there are a lot of educators that are already making qualifying payments towards that 10 years, and they maybe only owe 3 more years or 5 more years or 6 more years of payments. They don't owe 10 more. You can already be making qualifying payments, and the start date for that was October 1, 2007. So we're seeing a lot of people actually achieve forgiveness as of October of last year. We've actually had a couple of people in California that have received this forgiveness, but it's continuing to roll in. Anyway, the refinancing is great when forgiveness is not an option, or if you've got a higher income. Let's say a spouse makes significantly more money and you file your taxes together. This can be a great option. Or we see a lot of superintendents and principals that will look to refinance, but mostly it's for private loan debt. If you have a private loan, those programs we looked at don't qualify. About 3 out of 10 teachers that have loan debt have some sort of private loan, and those teachers benefit most from refinancing. And our average refinance client saves about $130 a month, which is a pretty substantial amount. So we're really proud to have that partnership with Citizens Bank. And I think, yeah, that really summarizes my portion on the student loan side. Again, I'm really proud to be here with AAEE and to share this information on student loans. And Jim, thank you for having me share some of the value proposition stuff that Horace Mann does.
Great. Thanks, John. And just in conclusion for the prepared remarks on this subject, we, as you take a look at and consider the information that we've shared, we would love to work with your College of Education or your placement office with regard to student workshops and student education. And ideally, if you have, we understand in some areas that we work, we do have universities or colleges of education that tend to place their employees in certain districts or in certain areas of their state or locality. And so to the extent that you folks work with your counterparts who are hiring your students, we would love to explore working with you to basically build that bridge between your school as you're preparing folks for entry into the workforce and those hiring employers to work with them on student and then bridge to employee education to make entry into this profession just as positive as it can be. So without any further ado, we'll open the floor for questions.
Oh, I should probably add also that we do currently work with several universities. So if we've got a rep that's really tuned into a certain university, often if they're an alum of that university or if it's in the city that they operate in, we are already connected in several universities across the country, from Florida to California, Michigan to Texas, and certainly in Illinois. But we do welcome the opportunity to partner with universities, and we do customize our delivery option to the university as size and scale merit. So if you've got some massive audience, we've got some literature for you and some digital offerings. If you've got a need to have a workshop presented in one of your education classes or in that kind of setting, or if you want to set up an after-hours workshop or seminar, that could be an option as well. We're open to figuring out how we can best serve you. This is something we do just to add value to the career and the partnership, between Horace Mann and educators. And again, I'm not sure if we stress this enough. This is something we do not charge for. There's no timeshare to buy at the end. There's no bait and switch here. If you go to, say Mexico and you go on this all-inclusive and they take you on this all-day tour and, they're giving you all these things and T-shirts and blankets and stuff. And at the end, they're like, all right, sign here. It's $15,000. Like, whoa, no. We do this as a service for teachers and those in the education industry. We're proud to do it for free. There's no charge or bait and switch. It is not like that. You're not required to buy one of our products. We're just happy to do it. You won't see Horace Mann on a Super Bowl commercial either. That's something I said in the last webinar, I think, Jim. That's actually how we can afford to do it. We don't do a whole lot of national marketing. We try to find ourselves actively in the schools and working with associations like AAEE so that we can add value. And we're confident that if we do that, our products really sell themselves since they're priced for educators. Educators tend to be more responsible drivers than the average person, so they qualify for better rates, and we've got educator benefits. But that's the business side. Our value prop side, our value side is what we're here today to talk about.
This is Tim Newbert again. I just want to thank you guys so much for this information, incredibly valuable. Particularly love the hero slide, John. So we'll be sure to highlight that in our social media around this recording. But truly appreciate your time today. I don't know if we have any questions or not from attendees, but again, I want to thank you tremendously for sharing with us today.
Terrific. We're happy to do it.
Yeah, thank you, Tim.